Hi, we're back in extra innings here. Thank you to everyone who joined our goals webinar earlier this week. We had so many questions from the audience. We wanted to take a minute to come back and answer some of those for you. I'm Katie Durkin, and I'm joined by Chris Marangi.
Great to be back.
Thanks, Chris. So some of the questions that came in during the webinar had to do with the fees after the first year. If you could talk about that a little bit.
So yeah, a lot of people offer teaser fees. Zero fees is our teaser. Most of the other ETFs in the complex are charging 90 basis points, which is what I expect to revert to after the first year.
Thank you, Chris. We had a question come in about the WNBA as well and women's sports.
So as the father of four daughters, it's something I'm interested in, certainly. Would love to see women's sports grow more quickly. Obviously, the WNBA had quite a year with some big stars. There isn't a way today to directly participate in the growth of the WNBA. Obviously, indirectly, we have the big media companies for whom that is more important content. Maybe one day. There are a number of entities that are investing in women's sports. Ariel's a firm we know well. Some of the principals there have been doing it. So high hopes, but it's a little premature.
Thank you, Chris. In terms of the transparency in the ETF.
Yeah, so we started when the firm started with ETFs. We started with the non-transparent variety. Those didn't gain a lot of market traction. So we think so. We went the transparent route, as most ETFs are. Can our top holdings be replicated? Sure. Obviously, we have some secret sauce in the holdings outside the U.S. And what we're buying and selling at any given moment. But we think ultimately what we add can't be replicated.
Okay, thank you. We touched on this a little bit earlier, but we have a follow-up question on diversification and the limited assets that are public versus those sports that are private.
Yeah, so although this is not in the prospectus, the holdings today, you'll notice, are a bit more than 50% kind of leagues, teams, promoters. And then, beyond that, it's that mix of ecosystem companies, whether it's media or, venue owners, ticketers, et cetera. So, we've got certainly with this relatively small amount of assets in the fund, plenty of opportunity to grow this fund. And we hope to get bigger soon. We've been building it kind of slow and steady. And it's hard to imagine a realistic ceiling for what we're doing.
I'm glad you mentioned media. Our next question here is, what are some of the media plays in the space?
Yeah, so among the larger ones are actually the Walt Disney Company, which I've been following for a very long time. I'm not sure I would call Disney a media company. Actually, two-thirds of the earnings for Disney and probably more of the value of the Walt Disney Company today derives from their experiences business, which goes directly to part of our thesis. It's primarily families spending money to go to the parks, to go on Disney cruises. These are things that people have budgeted for. And it's been a great driver of earnings for Disney. The new CEO, of course, Josh D'Amaro, comes out of that business, which is, I think, a signal of how important that is going forward. But certainly, of that remaining one-third or so, a significant portion of the value comes from ESPN, which was our slogan, the first name in sports, something like that. Again, a business that's going through some transition as we go from linear to streaming, but they've had some early success in people signing up for some of the enhanced content available online. And so it fits, right with what we're doing in this fund. We own some others. I mentioned Versant earlier, which has got a very important sports business with Golf Network. Comcast, obviously, with NBC, the Olympics today, as well as the NFL, important content for them. So, for all the old network companies, they're really driven by the NFL.
Thank you, Chris. We have a question here about betting. Are we investing in any of the betting platforms?
So it's what we've thought a lot about. I think there are definitely pluses and minuses to what's happened with legalized betting in the U.S. So in 2018, the rules effectively were changed, which allowed for legalized betting. On net, it's probably been a tailwind for revenue for sports franchises. It's certainly increased engagement and tune in. So even if the game is a blowout, you might stick around for 9 innings to see if your prop bet on, how many pitches are going to get thrown, something like that, pays out. I think longer term, there are some questions about what betting does to the reputation of the sports. Obviously, some recent scandals tarnish that a bit. We so far really have not invested in the public betting companies. In part, that's an economic judgment, a value judgment, valuation, not necessarily value judgment. Obviously, Kalshi and others, prediction markets, I think pose a near-term threat to those companies. We'll see how that plays out. I don't think, I have not made up my mind as to how that plays out. So to date, have not included them.
Thank you, Chris. Next question is about the rise of soccer or football in the US. And do you think that the NBA will have success in Europe?
Yeah, I like the second part of that question. Something we've been looking at. There are some ways to potentially play that dynamic, i.e. the NBA in Europe. And interestingly, obviously, a lot of the American leagues have tried to make headway outside the U.S. The NFL has their toe in Europe themselves, particularly in the UK and Ireland. And in the NBA has spent a lot of time there, and in China, obviously. So I do think the NBA Europe does get off the ground. Again, in some ways to play that with actually European soccer teams. Obviously going the other way, we certainly hope that the World Cup, amongst other things, increase interest in European soccer. And obviously there are a lot of teams to play with. The Formula One has been a great story. Not a sport that has waxed and waned in popularity in the U.S. See NASCAR being the first love for many racing fans here. But obviously, the Drive to Survive on Netflix turned a lot of people onto the sport. You've got a few races in the U.S. Which have garnered a lot of attention. I think one of the reasons that we own Formula One is actually MotoGP, which is a motorcycle race promotion. Super interesting. If you've ever watched one of these races, but they are kind of short, super exciting, guys getting thrown from bikes. I think this is going to be a big success in the U.S. and Formula One has an opportunity to replicate the playbook that they use to make Formula One so compelling.
Great. Thank you. Our next comment is from a OKC Thunder fan just saying hello. Thank you for purchasing shares of GOLS on E-Trade. Our next question is about
Got a great team this year.
Let's see here. Given the persistent disconnect between the private market valuations and the lower multiples seen in publicly traded sports entities, how do you envision this gap closing?
Yeah, so again, I think there are a number of ways that this could happen. I mentioned a few of them earlier in the seminar here. Public companies, public sports franchises either selling minority stakes in their entities or going private. I mean, that's ultimately one way to close the gap. I should mention one dynamic that probably comes up in a question later on is, and I'm going to go deep in the weeds here with this change in the tax code called 162M, which basically disallows publicly traded companies from deducting compensation for the top 5 paid employees. And that has a special impact on sports franchises because the top 5 paid employees of the New York Knicks, for example, are very highly paid. They're the players on the floor who make a lot of money. And so that's a big potential drag on the cash flow for MSGS. We'll see if this law change actually takes effect and if MSGS and the Braves and others are able to find a way to deal with that.
Thank you, Chris. In terms of valuations, what catalyst beyond a full sale will benefit these sports teams?
Yeah, again, I've alluded to a few of them. It's even beyond financial engineering and take privates. I do think that although it may cause some short-term pain and sadness for baseball fans, some of the changes in the structure of baseball that are likely to take place over the next couple of years will be structural positives for multiples in the business for baseball teams in particular. Obviously things like global expansion, which sort of counts in many ways as a new product for franchises and leagues. is a plus. Again, going back to Formula One, they have been able to upgrade their race partners, where they race and what kind of proceeds that they get from these promoters. We also talk about AI. We've thought a lot about AI, and will AI be a positive or negative long term for people in the sports business? Again, I think no immediate impact. One could think of ways in which this is a plus and a minus, but I think the fact that it is harder to imagine AI disintermediating sports is more of a plus than what AI might do for software companies, for example.
Okay. We have a question here about the Braves, and I'll do my best to paraphrase here. But the Braves broadcast was likely profitable for Main Street. So now that the Braves are going to try to broadcast on their own, do you think they can make more than they were getting?
So this is clearly from somebody who follows the Braves closely. So just to take a step back, regional sports networks, RSNs, were a primary revenue driver for baseball, hockey, and basketball. Main Street had the wrong capitalization. They had too much debt. They declared bankruptcy. They carried the Braves as well as a number of other teams. The Braves and the Tigers actually have yet to settle on a partner for the 2026 season. Pitchers and catchers have already reported, so we're already into the season. I think that's the Braves' choice. I don't think that's a sign of weakness in any way. The Braves have the largest footprint, or one of the largest footprints in baseball. And includes not just Atlanta, but Nashville and Charlotte, amongst other places. And very highly watched, highly rated. They probably were the most profitable team partner for Main Street. So I think the Braves are going to be able to sign a profitable deal. Bigger picture, what baseball would like to do, and Rob Manfred, the commissioner, has talked about this a bit, is to basically take all the rights back for television and create a national product, which would presumably commence after all the rights end up coming back in 2029. We'll see how that plays out. I think one of the complications for that, as well as for basketball and hockey, frankly, is how do you make sure that the big market teams, including New York and Atlanta, obviously, get paid their fair share for bringing in so many viewers? Again, work in progress.
Okay, thank you. Our next question here has to do with private equity and other firms developing some sports-focused ETFs. Do you think our public market ETF is missing any of those opportunities?
Well, so I think that's actually I think some of the private equity firms who have been successful in this area, and KKR's recent announcement that they're going to purchase Arctos, which has been one of those firms that's been a trailblazer in this area, is actually an endorsement of what we're doing. It just shows that this is a great place to invest. And obviously what they're doing is different from what we're doing. They are, dealing with private stakes, liquid stakes, charging a big fee for it. We're the only fund that I know of to date that is focused on publicly traded entities. And so we're doing something a little different, and we think we're going to be successful with it. But, there is a question I've gotten before, is whether those private equity firms themselves become targets for our fund. Again, something that we've considered. We're considering it before KKR bought Arctos. There are a number of firms, including Apollo and CVC, which is international, that have big sports businesses. And I think we don't want to stretch the definition of sports and live too much. But those revenue streams, particularly for a firm like CVC, has probably gotten big enough or important enough that they become meaningful, and things we're considering.
Thank you, Chris. Our next question here is about raising additional capital for the ETF. So there's been some great adoption over the last 5 weeks, and where do we go now?
Well, we were New Year's baby, born on January 2nd. So we have seen certainly a lot of interest, and hoping to raise a lot more capital. We've kind of, again, it's been I would say a steady start to what we're doing. I'd rather have steady, committed capital than very quick, hot money. So we're out there telling our story. We think there's a lot of interest, a lot of potential, and basically we're seeing flows build each day.
Thank you, Chris, and thank you. I'm so glad we were able to do this second portion for our audience. And with that, take care.
We love overtimes. Thank you.
Chris Marangi is the co-CIO for Value and a portfolio manager of the GOLS ETF. Katie Durkin is a senior vice president at GAMCO Asset Management. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. This webcast was recorded on February 11th, 2026. As of February 18th, 2026, the top 10 holdings of the GOLS ETF are 1. Atlanta Braves Holdings Inc. C. 6.60%. 2. Madison Square Garden Sports 6.43%. 3. Liberty Media Corp. Formula A 6.29%. 4. Rogers Communications Inc. B 5.16%. 5. Liberty Live Holdings A 5.14%. 6. Manchester United PLC CLA 5.13%. 7. Madison Square Garden Entertainment 4.60%. 8. TKO Group Holdings Inc. 4.42%. 9. The Walt Disney Co. 4.16%. 10. Cannae Holdings Inc. 3.21%. Shares of this ETF are bought and sold at market price, not NAV, and are not individually redeemed from the fund. Buying or selling ETF shares may require additional fees, such as brokerage commissions, which will reduce returns. These additional risks may be even greater in bad or uncertain market conditions. Funds investing in a single sector may be subject to more volatility than funds that invest more broadly. You should consider the ETF's investment objectives, risks, charges, and expenses carefully before you invest. The ETF's prospectus is available from G. Distributors LLC, a registered broker-dealer and FINRA member firm, and contains this and other information about the ETFs and should be read carefully before investing. To obtain a prospectus, please call 800-GABELLI or visit gabelli.com/ETFs. Distributed by G. Distributors LLC, a registered broker-dealer and FINRA member firm. 1 Corporate Center, Rye, New York, 10580,